In a good investment product, the risk is managed well or mitigated well, right? So that we do at bonds and on Wint Wealth. We only bring bonds where we co-invest. The greener pastures are always there. So wherever there are unicorns already created, those are the, you don't actually need white space. Industries are same. You just need a different basis.
Hello, this is Open Tap by Gemba Capital, where we talk to stakeholders in the startup ecosystem, talk to them about trends, business, their users, and how their journey have been. Today we have Ajinkya Kulkarni, who's the founder of Wint Wealth. Welcome, Ajinkya.
Thank you. Thank you for having me.
All right. So let's start with getting to know you better. What was your journey up till you started Wint Wealth?
I graduated in 2012, then worked in my father's family business. It's a small business for a couple of years. Then started my first startup. It didn't work out great. Then worked at a couple of fintech startups for 2-3 years, and then started Wint.
All right. So, Wint, let's talk about Wint Wealth. How did you start it? What's the idea?
Uh, Look, so when I kind of moved on from my last startup, I was very clear that I'll come back, build something big. So whatever money I was saving, I didn't want to waste my time learning investing. So whatever money I was saving, I started giving that money to my father because he had a bank loan at about 12%. He said, "I'll give you 11%," and for me it was a sweet deal. And I moved on. And a lot of my friends, colleagues like that, 2, 3 of them actually gave me money to put in that sort of scheme. That actually intrigued me, saying why are people interested, and that's when we figured out what people want is something that gives double-digit fixed return, but it's safe, is liquid, right? And that was the genesis. Can something be built here? And then we at the same time we're seeing, very high growth on Zerodha and Groww. So we said there is something getting built on equity. There is nothing on fixed income platform. Can we build there? Is there a need of platform? And we believed, and then we started building.
All right. And what are the core offerings of Wint Wealth today?
Today we sell bonds that give you about 10-11% fixed return. Generally, these are retail listed bonds, 1-2 year tenure, and the good thing is you can also sell them anytime.
Okay. So, how have you gotten to that stage where how these bonds are different from the bonds available on any other platform?
Uh, Many of these bonds are available on these many other platforms, but some of the bonds are very unique to our platform. So we help issuers get into the market, issue bonds, and then these bonds are exclusively available on our platform.
All right. You also mentioned about liquidity. How have you solved for that problem? I think for the longest amount of time, the problem in the bond market was you had to hold it to the end of tenure, or you had to, when you had to exit, there was a liquidity issue, right? So, how have you solved for that?
I think it is all function of how many retail investors you have in the market. Now we have one time at least invested once. We have about 3-4 lakh investors,
Okay.
right? So if the buyer set is very low in number, there is always going to be lack of liquidity, and there is going to be problems in selling. But if there are large set of investors, that means on a given day, if you want to sell, there is going to be someone to buy, right? Then you just have to provide a kind of a intermediate liquidity that is very easier to manage. So this is all function because there are now more retail investors coming. We have 3-4 lakh bond investors who have invested one, right? So if you want to sell, somebody is ready to buy.
Cool. So, I think congratulations on recently closing Series B funding. Can you tell us how your pitch has evolved from your first pitch to the last one?
Which for us hasn't changed materially, to be frank. The good thing is now, like 2-3 years back, there was a formal regulation for online bond platforms. So that has boosted a lot of investor confidence and also has taken out the regulatory risk, right? So a lot of discussion in the pitch are on the regulatory changes. How are the regulation changing? Is it helping you? Is it not helping you? What do you think are going to be regulations 5 year down the line, 10 year down the line? right?
Yeah. So did you foresee these regulations coming? Did you know,
Not really.
not really? Okay. And how does that impact you, like going forward after the first regulations came out and you were able to comply with that? How do you see them evolving on an ongoing basis? Do you think that they can?
I think we were also very naive when we started. We didn't have much idea. When regulation came, actually overnight our platform volume fell by 80%. So
Okay.
we were doing water 100, then we started doing 20, and then we had to rebuild from there. Uh, the good thing is now it's been 2 3 years, and we have also evolved, and we are part of the association which is actively engaged with the regulator. So you get more sense on directionally how the regulations are gonna be there, what are the concerns before it comes into regulation or a consultation paper. You have as association you can put your point of view. So all these things are there. Overall bond market deepening or utilization as bond market has been mandate from all government regulator, government, etc. So in that sense, that is great thing because it gives us a lot of tailwinds.
All right. So talking about the bonds, let's say as a retail investor, if I am getting a fixed deposit with a yield of, let's say, 9 to 9.5 versus a bond which is giving me a yield of 9 to 9.5, what would you say is better?
No, if you get similar yield, go for FDs. There is no question. Bond are obviously riskier than FDs. So if there is no even 2% delta, and no FD is actually giving 9% today. FDs will be about 7-ish%, 7.5.
Yeah, that'll be the rate of interest, but then the yield would be, annualized yield will be higher than that. But yeah, I
That you
think,
can do in bond. So I'm just talking about YTM to YTM.
yes, YTM to YTM would be 7 versus 9 today.
No, no. At least you should have 2.5, 3% delta. Then only bond makes sense.
Okay, for that extra 2 to 3% higher returns, how much the risk the user is taking? How would you?
See, I mean, if you go for any higher yield product, you always take risk. Even equity, there is a risk. And a good investment product, that risk is managed well or mitigated well, right? Uh, so that we do at bonds and on Wint Wealth. Like we only bring bonds where we co-invest,
Okay, so
right?
you're taking. What do you mean by co-invest?
So if we are bringing a bond of 10 crore, we'll invest to 20 lakh from our own company with the intention to hold till maturity. What that
Okay,
makes sure is that we have our own underwriting team, in-house risk team, which does a thorough due diligence even in on ground, lot of factors, right? And only bonds that pass all that criteria and where we are putting our money in, we are bringing on the platform, right? So we have skin in the game.
the bond market is really exploding right now. So what do you see next? What next on your platform right now? Bonds are being offered. Where does it go from here?
We will go horizontal. What we have realized that if you have onboarded a customer, gain his trust, then you can cover other asset classes and get bigger share of wallet. So at some point we'll go horizontal.
Can you expand on that? What do you mean by going horizontal?
Like equity, we'll do something on equity because it is one of the main asset class, especially younger folks. I mean, when I say younger, not very young. Like our base is 25 to 45.
Okay.
These folks still have majority of their investments in equities.
All right. Got it. And how do you see the landscape of fixed income, the bonds market evolving? Do you think the potential is there? What is stopping from it becoming mainstream for retail investors to start adopting this at a level which the mutual fund adoption or the equity adoption has come?
I think tax benefit, there is like the taxation difference still plays a lot of role.
Okay.
Uh,
You mean the tax?
on equity is 12.5 and bond are taxed at marginal rate,
Okay.
right? So there should be parity. If there is a parity,
Yeah.
bond will also skyrocket very fast.
Yeah. I think recently there was some change in how the debt mutual funds are taxed, right?
Yeah, their benefit went away actually.
Went
This
away.
was a
So
couple
there's
of years.
the parity between the debt mutual funds and the bond, at least that has been.
Yeah, but that doesn't that doesn't count, right? I mean, the
Yeah.
people are gonna compare this with equity basically, and the tax benefit or taxation percent equity is very much attractive.
All right. How, let's say, everybody's today having impact on their businesses because of AI. So how that has led to any change in your, the way the user is having expectations from you, how your margins are changing, or any other impact?
Now, ours is a very real business in that sense. Like you have to do a thorough analysis from a risk perspective. You have to negotiate with issuers. It's very not very ops heavy, but there is actually a lot of human intervention required. What AI has enabled, especially for us, is uh, like we have just started automating customer chats and etc. In the first month only, we reduced the load by 35%. So now like 35% of the chats are auto handled by AI, and now we are integrating deeper tech there. And in 3-4 months, we should be automating 80% of the conversations.
Oh, nice.
Right. So
And
that is one big benefit.
okay. But in the ecosystem, we are seeing a lot of automations and value addition happening on the collections and the underwriting side.
Hmm.
Are you seeing anything that?
Yeah, a lot of underwriting flows that we have automated using AI, which were not earlier available, right? So, if like especially in monitoring side, like so, if you have basically bought a bond of a issuer, then we have now set up alerts, and AI only can decide what is the gravity of the alert, and then highlight accordingly. And that basically adds much more input rather than somebody going manually Google search and then figuring out. And then there are very specialized sources, kind of mini agents we have built, like which have access to our paid subscriptions, so that whatever data we get from there, its first level of auto analysis is automatically done. So yeah, in that sense, we probably uh, haven't expanded our risk team that much because AI is helping. So there is obviously some operational efficiency, and obviously in coding also. I think compared to a year back, um, our output is kind of double, but we would have probably had three coders. So 10% more hiring, but double the output.
Engineering output, you mean?
Yes.
Nice. What are the white spaces you're seeing in the ecosystem? I think you've been a veteran in the fintech industry now, spent a
Not
lot
veteran,
of
but yeah.
spent a lot of years in the
Hmm.
fintech industry now. So, what are the white spaces you see across the board, whether it's to do with the investments or any other space in the ecosystem?
So one of the thing I've realized is that the greener pastures are always greener. So wherever there are unicorns already created, those are the like you don't actually need white space. Industries are same. You just need a different wages. So if you look at FNO, equity, payments, credit cards, any and into the some extent as an operator being optimistic, I believe always there is a wedge available. It is about somebody taking that shot, doing right execution, having right insights. So these are evergreen things, right? Mutual funds, for example, not even distribution, but even manufacturing of like the proper AMC license, right? Where you see unicorns being created already, there are always going to be space for new unicorns.
Interesting. So you're saying instead of focusing on coming up with a completely new space to explore or a completely new idea, what founders need to do is find a wedge in an existing big market
Yes,
to solve a unique user problem and go after that.
Yes.
Nice, interesting. So, what would you advise, let's say, a founder who's out there raising funds for the first time? What would you say they should do, at least a must do and something they must avoid?
So there are 2-3 categories, especially for early stage funding. Uh, Try to like not try to. Some business may require higher EA, but if you want to higher capital, but if you want to raise then less than 1 million, then you can raise without VCs, just on back of angels, operators, and micro VCs, which are easier to close. Uh, so if you can raise that much, you at least have a shot at success.
Okay, so you're saying the founder should optimize for closing faster.
Closing.
Yeah,
Many times I've met founders who said I want 2 million, itna hoga. And I ask them, okay, if you don't get 2 million, if you get 1 million, you should shut it down, right?
yeah,
Because you're saying itna to chahiye minimum. They're like, nahi, phir ye hoga. And then like so there, if you're okay with raising 1 million, try to raise 2 million, but the form factor completely changes. So here is a playbook that always works. Is like, see, in ideally, if you can raise 100 million, you should raise 100 million. Pre PMF, your value of equity is zero, so you should not care about dilution.
Yeah.
right? You need lot of money, and that generally helps. For good founders, having high valuation and having pressure doesn't matter. These are all bullshit things, right?
Interesting.
Money is the real thing. You should have much, like more the merrier, uh, right? So if you believe that sub 1 million I can raise and build to the next stage, you should first start with friends, family, then operators in your space, and reach somehow quarter a million, and then go to micro VCs, and then try to reach somewhere between half a million to 1 million. And once you have that commitment, you should open the round for VCs only for a couple of weeks,
Got it.
and
Yeah.
you might end up raising 5 million, 2 million, and that's basically throwing dice. Otherwise, just close that round and get back to execution.
Yeah. Basically, you're saying the validations from those people, whether it's your family, whether it's your peers in the ecosystem and micro VCs, those validations really help.
Not really.
No?
No. It's just that money, like you need to go back to execution. You need money. So if you keep chasing VCs, and you are a VC, like I know venture partner, but there is no incentive for you to say no, right? Like why would you let off a go deal unless you are pushed back against the wall saying, give me check today, or say no. So VCs will keep entertaining you, and you feel like, and obviously it's hard for their side also.
Yeah, I think I have seen VCs not say no because they never know what comes back around. What comes back, and
maybe,
they might have to change their
maybe
thesis.
you do phenomenal execution and you
Yeah.
become a rocket ship in next round, and the VCs don't want to be saying no in previous round.
Correct.
Carry that baggage.
Correct.
So it's in their self-interest to not say no.
Correct.
But also not to give you money.
Yeah.
So idea is that if you have reached, let's say quarter a million, and you think you can execute with that, just close that round and move on.
Right.
People keep waiting for VCs. Validation वगैरह matter नहीं करता. मतलब मेरा ये what I've realized कि validation comes from user. If you like really build a good business, eventually like there is no dearth of money, right?
Yeah.
At every stage there is enough money available.
That's true. That's true.
So
for the right
founder, for the right market, there is always money available.
That's right.
Right. So just close. What happens is, like, if you, let's say you have a 1 million commitment and you're not closing, even those 1 million guys backing out, probability is high. So it's not about closing first. Just fucking close and build.
Got it. Yeah, that's very interesting and different from what we hear in the market today. Let's say there is a fintech founder who's starting today. From your learnings, what would you say they should avoid or they must do as a fintech founder? Should they keep an eye on the regulator? Should they know what they're trying to do? Is somewhere going to get regulated down the line?
Don't start in spaces where there are no regulatory tailwinds. And we are very fortunate, and like in a lucky sense, that when we started we didn't know, but like SEBI has very high push, RBI has very high push, government wants to grow the bond market, and we are beneficiaries of that. And if you're a fintech founder, if you're wanting to start up, just listen to as many speeches of SEBI chief, RBI governor, finance minister, and you'll get a sense what you'll keep hearing these themes that we want to grow this.
Nice. So you spoke about founders, should be closing faster. But what should the founders be expecting from their investors? Let's say micro VCs, when they get those people on board, and how should they choose which investor is the right from them if they have similar offers from multiple people, or in general, let's say they have gotten somebody on board in their journey. Now, what should their expectations be from that people who they have onboarded as investors?
There should be no expectation. Just choose a guy with good reputation, because investors they're highly probable to do negative validation compared to doing positive validation. So just make sure
that's interesting. What do you mean really by negative value addition? And
people being impatient, people being assholes, right? So if you get multiple offers, just talk to the portfolio founders.
Okay, so go with the people who are most likely to bother you the least.
Yes.
Yeah.
Who have proven track records, right?
Proven track record of not bothering the founder so much.
Yeah, because most of the companies go through some or other rough patch, right?
Yeah.
So only those founders know how they're investing.
Okay, so you're saying basically founders should go after investors who don't bother them so much in a rough patch or be supportive in a rough
Yeah,
patch.
yeah, bothering is a wrong word. I mean, investors spending time on businesses, but they should have patience. They should have faith.
Yeah,
Right. Fortunately, we are backed by all great investors. So, and we have seen when we went through a rough patch, it comes out like. Uh,
any value addition you saw from that, any of your investors during that
no, there is
rough
always a
patch?
value addition, but I'm thinking I'm not gonna choose investor for the value addition. I'm gonna choose investor for making sure that he's not creating destruction.
Got it.
Yeah.
Interesting. Very different from what we had in the market today.
Yeah, because at the end of the day, if you keep focusing on users, if you keep building right team and keep executing, you will get there without like. And I haven't. I am yet to find out a unique validation that only investor can do. I'm saying if it is such a requirement, like some validation, I'll rather hire an expert or get a consultant, and those kind of skill sets are always available. I don't see any unique skill set, and there is basic smartness among all VCs, right? They've been trusted with money. They have hundreds of millions, so they are obviously smart. So they will anyway do validation. What you have to make sure is you don't get the bad guys because then you're screwed.
Got it. All right. I think this was a very insightful conversation. Thank you, Ajinkya, for your time.
Yeah, no, my pleasure. Thank you.